Hello. Thank you so much for joining us today. My name is Kim. I am a financial wellness coach here at New Hampshire's Federal Credit Union Centers for Finance and Education. And today we're going to be talking about the basics of savings and credit. So this is geared toward younger adults, but it definitely applies to everybody. So even if you're not a younger adult, and I reference young adults, don't worry, this definitely goes for everyone, okay? So again, my name is Kim. I am a financial wellness coach, and I have had over a decade of coaching experience with educating clients on financial basics. And so this is what today's class is going to be. We're going to talk about savings, the tools you use to save, and also credit, the importance of credit, and the things that you want to look for and how it affects you, okay? Because a lot of people don't get this type of education, and they get into really bad situations, and then they get this education and they're like, oh my goodness, only if I had this sooner. So that's why we love bringing this out, because it's definitely something that people need to have an understanding about when they're working on their finances, right? It's always good to know the purpose behind something. You always want to know the pros, you always want to know the cons, okay? That's what we're going to talk about. So the basic thing when it comes to savings and credit is, do you actually control your money? Most people will say, yes, of course I control it. But in actuality, it controls them. And this is typical when we talk to clients when they're like, I don't know where my money is going. If you've ever said that to yourself, then you're not in control of your money. Okay? That one simple phrase. And so we're gonna teach you and show you what you have to look at to make sure that you have control of your money. So you have control of your savings, you have control of your bills, you have control of your debt, and you have control of your credit. Okay? So there's going to be 3 steps we're looking at today. Making a personal budget, and now I know the class said about savings and credit, but in order to do step number 2, which is set financial goals and save, you need to have step 1 in place. We need to make sure that we have that personal budget, also known as a personal spending plan. We need to have that in place, because if we don't, then there are different paths that our money takes, and it won't be to savings, okay? Step 3 is going to be establish good credit habits. When you are first starting out, it is a must to understand what your purpose of credit is, okay? And the goal you want to reach with the credit, and how to use the credit and the debt instruments. That is one thing people do not talk about, is how to use it, the best way to use it, okay? So first we're going to look at the actual budget itself. And we're going to spend a little bit of time on this because it takes some explaining. And when you're first, getting a job, even if it's just babysitting or walking dogs or, something that you're getting paid cash for, anytime you have any type of income, it's always good to have a budget. Okay. So this is what a budget can look like. Now, this is something that is a template, but you can create this yourself. You can put it in a notebook. You can do it in Excel. You can print out sheets. If you Google budgets, they come up with a ton. They're all a little bit different in the way that they organize themselves and then the way that you can follow them. And so it's really coming up with a way of organizing your money that works best for you. Okay. Now, the one thing with a budget that most people don't understand is they think as long as you have enough money to cover your bills, which typically are housing, utilities, credit cards, car loans, and those things, they think if they just budget for those, that they're going to be fine. But you'll see once we go through the budget that you actually need to account for all spending. And what this budget does is it creates a plan for you to move forward and to have a plan for every dollar. Okay? Because if you have a plan for every dollar, you are less likely to overspend. Because you know if you go to spend money on something that you didn't plan on spending money on, that has to come from a different category. And then you have to figure out where that money's coming from. And so what we're doing is we're setting up our psychology and our spending behavior to be proactive rather than reactive. Okay. Most people are reactive. It starts to get the middle of the month. They have other bills coming due. They're low on money. Now all of a sudden they're stressed beyond belief, not knowing how they're going to pay their bills. And so they might say, well, it looks like I'm having beans and franks for every meal. Okay. That's a reactive mind. That's a reactive behavior to finance, where things weren't taken care of the way they should have been, and now you're reacting. What do I have to do now to make sure things get paid? Whereas with the budget, you're proactive. You say, okay, this paycheck is going to this bill, this bill, this bill, this bill, this expense, this savings, boom. The next paycheck is going to this bill, this expense, that expense, and this savings. And you know when your check comes in exactly what's getting paid and what's getting saved. And you really don't have to think about it past that. That's how being proactive and doing a little bit of work the month before, getting ready for the upcoming month, can save you all the stress. Okay, so let's look at this. In typical budgets, they don't have this part of things, right? Usually the only thing that they have is your net monthly salary after taxes. So this amount right here. The reason why we use the net and not the gross is if you get paid so much every hour you work, same hours, and you get paid $30,000 a year. That's your gross, okay? But then you have different items coming out of that. These are what we call deductions. So you have your federal income tax, you've got your Social Security, your Medicare, and if you live in a state that has state tax, you'd have state tax taken out. Okay, and then you have your total of the deductions, which gets deducted from your gross amount, and it comes out with your net. We always work with the net monthly salary on your budget, okay? The reason why we do this is because we want to make sure we're budgeting with money that you're actually receiving. If we made a budget according to what you were making before the deductions, we'd have a budget of 2,500, and then that way you would overspend, okay? Because you're not getting that full 2,500, you're only getting about 2,000, okay? So that's where we start. And then you can see as we go down, we have expenses. So we have housing, we have savings, how much you're going to save each month, housing, how much your rent is, if you're renting with friends, if you're staying with family and paying family. So that's something that we go ahead and put on there, okay? If you have student loans, transportation, if you have an auto loan, you want to make sure that you pay for that. Any insurances, health will sometimes be directly taking out of your paycheck if your employers offer it, or some people have to pay for it out of pocket. So definitely go here. Auto insurance, if you have a car loan, you have to have auto insurance in New Hampshire. And if you're renting, you definitely want to make sure you have renter's insurance. Okay. But so this category right here comes out to $950. And then we have the second part of the budget. If you're living with family, which is what this was based off of, living with family, saving up for a home, then typically that $500 for rent kind of goes toward room and board and all the like heating, electricity, all those type of utilities, okay? Usually you'll still have to buy your own food. I always like to have people plan for that just because that could be a high possibility. So I'd rather have you budget for it than not budget for it. But this is how I show that the budget is more than just your bills, right? So food technically isn't a bill. Food is an expense. Food is what you use your funds on. And this is a category that most people don't put in their budgets. They don't realize that they have to account for this. Gas for your car. You have to account for that in a budget as well, okay? Then all the discretionary items. So if you go to a salon, if you go to a gym, if you have pets, gaming, any type of shopping, shopping can be clothes shopping, shopping can be auto parts shopping. It can be anything. That all needs to go in your budget. And you might be like, oh my God, this is crazy. Why do I need to keep track of all this stuff? And you also might be saying, well, it's not like I shop every month, but I do like to go maybe seasonally and go 4 times a year and things like that, or and I'm going to show you how that works with the budget. So you can see here from the 2 forms that I had to trim just so I can make it big enough for it to look good on the webinar, is we come down here, and after we look at all our spending, because we have a personal loan as well, we are spending $2,000 on bills, expenses, and savings. That leaves us with $8 a month. But then if you see back here with savings, that's 85 we're saving for. That is a pretty small amount for savings per month. I mean, any little bit helps, but if we're saving for a home or saving for a bigger goal, we want to try and be able to save as much as we can, right? And so how do we save more? When we look at our expenses, when we look at our bills, we're doing pretty good and we're really not spending that much money. So here we have the option of a part-time job. So if we have a part-time job that we make an extra $500 a month, this is actually how my husband and I got out of debt. was we each got part-time jobs, and all that our regular income went to bills, expenses, and then our extra income actually went to paying down debt. So that's how we were able to really go for it, is we're like, you know what? I'd rather have a part-time job for a couple of years and get our debt out of here instead of, you know, being able to relax in the weekend, but having debt for 15, 20 years. That was our choice. But so here you can have a part-time job, and now you have a surplus of $508 that you can tell yourself, okay, I'm going to put $400 away of this into savings, and then $100 is just going to be like my fun money. It's just going to go to whatever I want. If I want to be just, if one weekend I want to go hang out with friends and go to an escape room, boom. It helps you stay low. So if you still want to be spontaneous, you can have a little category that says spontaneous. That's a great thing. Okay, so that's what a budget does. It highlights everything that you spend your money on for the month, and it tells you exactly, okay, I put $100 away for shopping. So if I need to go get, if my shopping is, I like to fix cars and go shopping for parts or little things, I have $100 to do so. Now, if I find that I want to save a little bit more for that, then you just make it fit in your budget and you look at the other categories, okay? So the reason why we like to do this is because once you have a budget and you have all your bills, expenses down, you know everything is covered, you can make those educated decisions on where you want your money to go as far as saving, okay? And I am a big promoter of saving for things and not putting it on credit. And we're going to talk about building credit, using credit wisely, and not going into debt, okay? Because this is the type of education that is really not promoted, okay? So we want to save money. So we want to save money for purchases and for retirement. Now, most young people don't even think about retirement because they're like, oh, I'm going to be working for like 40 years anyway. Why am I even thinking about it now? The reason being is because with compound interest and saving now, by the time, if you get used to putting money away in savings and not using it and just letting it grow that entire time, you are going to set yourself up that you may not have to work till you're 67 or 62. You may be able to retire at 50, okay? All depending on how you take care of your money and how you use it and how you use debt and credit and not living outside your means. Now, this is just a sneak peek of savings accounts that I have, okay? These are what we call expense accounts. So, you know how I mentioned, for instance, the shopping category. If you don't shop every month, but you do it seasonally, you can save every month. And instead of being an expense, it's an expense savings. It's a savings that you save up. And then that way, when that expense comes, you have the money in the savings account. So if you go quarterly to go clothes shopping seasonally, then you'll typically have about $300 each season to go shopping if you just saved on the months that you didn't go shopping, okay? That's how it works. That's how these savings work. For instance, we have baby savings. We have little ones, and they are expensive, so we have a savings account just for them. So when we need to get something for them, or if we want to get toys, we're not breaking our checking account, which is just for our bills and regular expenses. So we don't touch that. If we want to get them toys, it's like, okay, we have this much available. You know, we know how much we use for diapers, for formula, for things like that. And so we know how much we have that we can spend on upgrading their toys, getting them new learning equipment, things like that. Mind you, we don't shop like that every month, but we still put it in savings so we have it. So if we want to get something big, if we want to get a swing set, you know, we're gonna have the money for it. Now, I know with the younger adults, this is probably going to be one that you're going to want to have, is a car maintenance fund. We put in a certain amount of money in this every month because we know we're going to have car related issues, right? We have the maintenance, oil changes, tires, tire rotations, things like that. So we know, and we know how much we drive, and so that's how we calculated how much we put in every month. But we do this that way when we need an oil change, we just move the funds to the checking account and then pay for it. If we need new tires, we move the money to the account, we pay for it. If we need to do any other type of maintenance, you know, usually we'll have the funds for it. We put it in the checking and we pay for it. That type of things, that helps limit your emergencies, because we all know that maintenance is going to be needed at some point. So this is definitely a category you're going to want to save for. If you have a car, you want to have a car maintenance fund. You want to be putting in savings a certain amount to cover that. And that's why I said when we looked at the budget and we only had $85 originally planned for savings, that maybe we wanted a part-time job because, you know what, I have an older car. I got something that would get me from A to B, but it typically needs repairs and I need to stay on top of it. So maybe I'll need to put a little bit more money in there and have those funds available. Okay, so that's something that you just definitely want to do. Okay, so, and as you're starting out, you probably won't have as many as I do. We actually have a total of 14, but that would take up the whole slide, so I just did a little screenshot. But when you're first starting out, you're not going to have this many, obviously. And so you just, as you go along and as you evolve in your personal life, you know, if you move out, if you're, you know, you have a significant other, life changes like that, then you will come up with certain categories that you need, okay, that you'll say, you know what, we're going to make a category for this because I want to make sure I have this available. And that's what you can do. One that you don't see here that you'll definitely want is what we call an emergency fund. I have that at another financial institution. And typically you want at least, when you're first starting out, you want to save at least $1,000 in that emergency fund, okay? So that will help if, you know, if you only have, let's say, $300 in car maintenance, but your car needs 4 new tires and it's going to cost you $400. Then what you do is you take the 300 from car maintenance, you take 100 from emergency fund, and you go from there. And then when you're saving, you're going to beef that emergency fund back up, make sure it's back to 1,000, and then go ahead and start doing your regular savings. Okay, that's another one that you want, and that will, you'd be surprised how much that's going to save you And with you starting out with having an emergency fund, and if you compare yourself to your friends who don't have an emergency fund, you are going to be so surprised how many emergencies they have versus how few emergencies you have, because you have the savings there to save you, right? And so that's a big thing. I am big component about saving ahead of time and having the funds available. And we'll show you a little bit more going forward when we start talking about credit. At the end of the credit, we're going to show you how savings versus credit, how they compare, and how much more you would be spending if you tend to use credit as a savings tool. Okay. So this is credit and how it affects you. Okay. So up here, so you borrow money and you are graded on it. Okay. And that's what most people don't realize. That the whole FICO score, it's a grade. Okay. It's telling us how good you are at borrowing money. In school, you get A, B, C, D. In adulthood, you get scores. Okay. 800, 700, 600, 500, 400, all the way down to 300, and anywhere in between. Now, just like with grades, 100 being an A, 800 is an A. And it goes down from there. Okay, so I want you to think about it as that. Now, your credit and your credit score, the main way it impacts your life is here. It's to get approved for loans. Loan officers will actually review your credit, but there's also some other things that it's becoming more popular with, and we're going to get into that in the next slide. But what I want to show you is what makes up your score, because this is the thing that a lot of people don't realize. Okay, payment history. This is the biggest part of your score, which is 35%. What does that mean? That means on your credit report, when you sign, let's say you get a car loan with us, with New Hampshire Federal Credit Union. You sign the paper saying, yes, I know the terms of this loan, this, and I know my monthly payment is $240, and I promise to pay back as agreed, to sign on the line, blah, blah, blah. Okay, you signed a contract with us that you know that your payment's going to be this much. It's going to happen monthly. It's going to fall on this date, and that's when the payment's due. Okay, so you're signing saying that, yep, that's what we're doing. And if you stick to that and you pay us that amount, at least that amount, you can pay more if you like to, at least that amount by the due date every month, we call that on-time payment. And that's all your payment history is seeing when you're paying this loan. Now, if you let it go past 30 days and you don't pay it, that's a tick on your credit report under that merchant, under us. It says, oh, they paid 30 days late. That brings your score down. Okay. Got to remember, payment history, if you're not paying on time, if you're paying late, it's going to give you a little check saying, not so good. And the reason why even just making it late is so bad is because it's the biggest percentage of what makes up that score. If you paid 60 days late, even worse. 90 days late, even worse. Okay. If you don't pay it at all, that's what we call a big whoopsie. Okay? And this is what happens to a lot of young adults. They'll take out cards, they will max them out, and they're like, well, I can't pay for it, but that's fine. It's not gonna affect me that much. It's not that much money. Oh no, it will affect you, because it doesn't matter if it's a $300 card, $1,000 card, or a $30,000 card. The algorithms look to see if you made the payment. If you're not making the payment, you're going to have a negative effect on your credit. And collections are the worst thing, because what it tells future lenders is that, yeah, you signed up to get this credit, you got this credit, and then you totally just decided not to pay. That tells every other lender that you're a really bad borrower. This is when you start getting into the low fives, the low fours. This would be like a D and an F on your scorecard, on your report card. Okay. So, biggest thing is, if you're going to sign on the dotted line for a type of credit, you want to make sure that you can pay it back. If you can't pay it and it's too much, you're just going to be hurting yourself if you sign on that line, because it's just gonna, it's going to be with you for a very long time. Okay. Amount owed. This is another big category, 30%. This is a category that most people don't realize either. So if you have a credit card and your limit is $1,000, how much money do you think you can use on that card to make sure that your score is helping build your credit rather than lowering your credit? 30%. They do not want you using more than 30% on your card. So if you have a $1,000 card, you should not be putting more than $300 on it at any given time. Okay. And this is where it gets tricky, because when people tell you to build your credit, they said, yeah, get a credit card, just make sure you pay it off every month. They always forget that 30% rule, always. And so I had somebody that was trying to build her credit, and her credit wasn't going anywhere, and she didn't know why. And I'm like, well, are you putting more than 30% on your card? She's like, I'm paying it off every month. Like, that's not the question I asked. Are you putting more than 30%? She's like, well, I have $1,000 limit, and I'm putting about 900 because I put all my bills and expenses on the card, and then I pay it. Okay, let's pull your credit report. Let's see what it looks like. And what was happening, she thought that her credit card was reporting to the credit bureaus every time she made a payment on her card. Unfortunately, that is not the case. The credit bureau, the merchant was reporting to the credit bureaus, to the credit report, on like a week before the payment was due. And so every month that card was reported, it always showed almost $900 of that $1,000 was used. And therefore her score wasn't budging, because it always showed that she had 80% of that card used or 90% of that card used, and that's a huge red flag for the algorithm. And so that's why I say never use more than 30% at any given time. Okay, pay it off 4 times a month if you have to, but do not go above that 30%. Length of credit history. This is how long your first merchant. So if you had a credit card when you were 18, or thinking about getting a credit card when you were 18, and you had it, and then you end up being 30, then it shows that you've had this card for like 12 years. Okay, and so that's the length of credit history. So the longer your credit history is, the better it is for lenders. The reason why is because they can see how you've been a borrower over a longer period of time versus if you got a credit card 6 months ago, that actually is considered insufficient credit history because it's been too short of a time that lenders can't actually conclude or really know how good of a borrower you are because you haven't really had it much very long. So that's what that score goes by, okay? Then we have 10% is a credit mix. So this is if you have an installment loan, which is like a car loan, you have a start date, you have an end date and the same payment within. Or revolving, which is like a credit card. It's when you have a credit that has, you have a certain amount available to you to use. You can use a certain amount, pay it off, use it, pay it off, use it, pay it off. That's what credit mix is. And then we have the new credit, the 10%. This is something if you get a bunch of new credit at a time, this is where it can actually lower your score because what happens is it kind of sends up a bunch of red flags saying, uh-oh, all of a sudden they're taking out a bunch of credit. I don't know if this just means that they're just getting it just in case or if they can't sustain their living with their income. And so now they're trying to supplement it with this credit, this new credit. So the more new credit inquiries you have will actually decrease your score, okay? And so that's why we usually say get 1 or 2 at a time and then hold off. And new credit stays on your report for 2 years. That's how long it's considered new credit. Okay, so you want to make sure that you understand that. Because that will help. If you get too much at a time, your score is going to tank. Okay. Now, for young adults, you will hear that you should be building credit. And the reason being is we talked earlier about qualifying for loans. You want to make sure that if you need to get a car, if something happens to your car and you need to get another one and you need to get a car loan, that you're going to be able to. Okay. If you have a bad credit report, bad score, it's going to make it really hard for you to get a loan that isn't going to break the bank. Okay. So what we look for, so here are reasons why you want to build credit. Quality for the best financial products that can help you save money or achieve your goals. All right. Apply for a loan. So these ones kind of go hand in hand. So if you want to apply for a loan and you want to get a car loan, if you have a good score, you're going to get the best rate. If you have the worst score, then you're going to have the worst rate. And that can be, definitely a few percentage points, but that can actually change your payment from $200 to possibly $600 a month. That's why you want the best score. This is why you want to build credit and you want to have a good score. And it's just like weight. Okay. I can say this because I'm a little heavy set. If you are a lower weight and you practice staying at that weight and staying active and eating right for you, it's much easier to sustain that weight than if all of a sudden you gain 80 pounds and then you have to lose it. Same thing with credit and your credit score. It's much easier to maintain a good score than to have it drop and have to rebuild it. Okay, so that is something that you want to keep in mind. And so, and that's why we talk about building credit and trying to do all the right things, because I don't want you to get in a spot where all of a sudden that credit score tanks and then you have to rebuild it, okay? Because that's going to take a long time and it's going to be ouchy, okay? Buy a home. This is where we talked about you want the best score possible, and this is where it really helps, because a home purchase is such a big purchase that even a couple percentage points could mean the difference of hundreds of thousands of dollars. Okay, so definitely want to be in a good spot, because if you've saved all this time to buy a home, you want to make sure that your credit looks good, because you don't want to get declined from your credit if you work this hard to get there. Okay, qualify for insurance. A lot of places are really putting their products depending on your credit and how you take care of your finances. Okay, for a home, one of the things is if you don't put down 20%, if you're doing, for instance, like a conventional loan, you have to pay what they call a PMI, private mortgage insurance. It used to be a set amount. It used to be $250, but they have changed it to go with your credit score. So for instance, with our credit score, when we bought our house, we had really good credit. Our PMI is only $20 a month. We put 10% down, our PMI is only $20. Whereas if I bought a house 15 years ago, if I put 10% down, my PMI would have been $240. And that's every month you have to pay that. That's not a one-time charge. That's a monthly charge. Okay, so that's another reason why we want to have a good credit score. Finding a job. This is one, especially if you want to be in finance. If they pull your credit report and they look at, and you're bad with your finances, there's no way you're getting a job in finance. Okay, so you want to keep that in mind. And give you a competitive during lending decisions, because there's multiple factors that lenders look at when they're doing lending decisions, that if you are a good borrower, you have a good score, and there might be something like maybe your debt to income ratio, maybe that's a little bit higher than they like to do. If you look like a good borrower and everything else looks good, that could actually help you, and they could decide to give you a loan because they know that you're responsible. Okay, so definitely taking care of that. Now, if you are a young adult and you are going to build your credit, here are some products or things that you can do to build that. So we have a credit builder loan. So it's a savings account that's kind of beefed up on benefits. Okay, and what it is it does have an interest rate, but what you do, let's say you want to save $1,000, and with the interest rate, you end up paying us $90 a month. Let's say 85 goes into what we call the piggy bank, and then 5 goes to interest. And we do that every month. Once you have $1,000 in your piggy bank, we break it open. So that whole time that you're saving, you can't touch it, but you can see it, but you can't touch it. So once it gets to 1,000, we crack it open. We take that $1,000, we put it into your savings account. Now you might be saying, well, why in the world would I pay interest on that? First off, it helps people who have a hard time saving. Second, it actually will report on your credit report, showing that because you've paid the loan, and the loan payment, which was $90, it shows up on your credit report. So people love to do this who don't like credit cards, who don't want credit cards, but want something continually reporting on their credit report. We have people that do this. This is their Christmas fund. This is their vacation fund. They save up for it year round, and then when they're taking their big vacation, they have it. And it was something that they decided to do because they want something reporting on their credit. They want to make sure they keep a good credit score. But credit builder loan, you actually don't need to get approved for, because it's really a savings, and we hold the funds. So we don't give you anything in return. You just save. And so it's one of those things where it's not like a personal loan where you say, oh, I want, $1,000, so we give you 1,000, then you have to pay us back. You're paying us ahead of time, and then we give you the funds. So that's how people that don't have any credit or insufficient credit history can start building their credit, is because this is something that you don't need to get approved for, okay, unlike other loans. Secured credit card, this is if you don't have credit, you typically have a hard time getting a traditional credit card. You can do a secured card. So if you have like $500, you can get a secured card for $500. And what it is, it's a credit card. It still has the interest on it, but it's secured. So it has that $500 associated. So just in case something happens where you can't pay it, it's secured by the cash that you put down. So if something happens, the cards can still be covered. So that's how it kind of sets you up good. So you're not having late payments or things like that. Definitely a traditional credit card. I'm not a fan of credit cards because I think they can really mess with people's financial behavior. And I just see so much trouble come from it that I'm not a fan. But I think if you start off with your good practices first and then go forward from there, that it can be doable. And we'll talk about reasons why you want to make sure to watch that. That's going to be the next slide. Be an authorized signer. So this is something that if you're a young adult and your parents are really good borrowers, they can actually set you up as an authorized signer on their accounts. And what's great about an authorized signer is you're not responsible for that bill at all. But when your parents pay their bill, hopefully they pay on time if they're good borrowers, that will actually show up on your credit report. That will help you build credit. And so we have a lot of parents that do this for their students. Well, they'll add their, not students, for their kids. They will add their kids as an authorized signer. They won't give them access to anything. Won't give them a card. No, you can't use it, nothing. But they just add them as an authorized signer. And it helps the kids build their credit score. Okay, so that's a great one. And always use debt for necessities and not for wants. Okay, we don't want you digging yourself into a hole because you started using if you did get a credit card, you start using it for everything. Okay, I don't recommend it. So, because you can get caught in traps. So I usually just say use it for necessities. Typically, especially a young adult, I usually say use it for gas only, and use it for just your gas. Don't be paying for all your friends' gas. Your gas, okay? And make sure it stays under that 30% rule, and just use it for that, okay? So that can, and what that will help you with is it will help you stay organized and not fall into this behavior of overspending. Okay, so these are reasons why you want to watch your debt usage. Okay. So when I was talking about your behavior when it comes to cards and how it can be a negative financial behavior, it's because what happens is the cards usually have an introductory rate of 0%. Okay. They don't do this out of the kindness of their heart. They do this because they want your psyche to think, oh, it's 0%. So I can borrow money now, not pay it till it's due, and not get charged. Even if it goes over and I only pay the minimum rate down, I don't have enough to pay it. If it rolls over to the next month, that's okay because I'm not getting charged for it. And you might say, oh my God, this is the most amazing thing ever. Most amazing thing ever. And so they do this for a year. So you can see where your behavior might start off innocent. And as the months go by, you start spending more. Because you know what else they also have on these cards? Reward points. Yes, yes. Who doesn't like rewards? Everybody likes rewards. And so what they're doing is they're getting you used to using that card, possibly not paying the full balance off every month, getting those points, and also using that card for more and more stuff each month, to the point where once you get to that 12-month mark, you might still have a decent balance on that card. And then the interest kicks in. And the interest is now 30%. And so now you're paying 30% on all your charges that roll over. Okay. So this is how people get trapped, because it happened on their first card. Oh no. Oh no, the interest started. I need to get another card because I want to do that introductory rate again. Get another card. Roll over the balance. Pay 3% on that. You're like, oh good, now it's at 0% again. Woo! But they continue to spend on their credit cards. And that's that behavior that I don't want you to get into. That's the behavior that once you're in your 30s, you come see me and you're like, I don't know what to do. We owe $30,000 in credit card debt. We owe $20,000 in credit card debt. We don't know how we're paying our utilities this month. It happens. The big companies know, and that's why they do it. Okay? So use it for necessities only, and do never go over 30%. And always budget in your budget for whatever you're putting on that card. Okay? 2, you tend to get into bad debt if you don't have a budget because you're not planning. Remember, we talked about being proactive versus reactive. You spend before you save. You make spending decisions on impulse. This happens because you have evolved your financial spending behavior due to the cards. You only pay the minimum balance due, right? So we're letting things roll over. And once that introductory rate goes bye-bye, you're now getting clocked with 30%. You make emotional spending decisions. So this is almost the same as the impulse buying, right? Or if you're not feeling good, a lot of people will just buy something to make themselves feel better. You have no emergency savings because a lot of people will say, oh, I have my credit card in case of an emergency. But your credit card is maxed out. They're like, yeah, so I had to get another credit card. Not the answer. Not the answer. Okay. You lack a realistic repayment plan. You strive to keep up with the Joneses, no matter the price. And if you look at all of these, it's not an actual financial issue. It's a behavioral issue, okay? And that's why I don't want you to set yourself up for failure, because you don't have the information to know what's going on. So these are the reasons to watch your debt. Okay. And this is my little payment calculator that I like to, it's very plain, very simple. So what I like to say is, because I'm a saver, you saw that I have the savings account. When we look at savings, this bottom one is savings, okay? So let's say I want to get a new TV. Mine right now is okay. It's kind of on the fritzy a little bit, but it's okay. It does its job. I can still watch TV. Not a big problem. So I'm like, I want to start saving for a TV. I'm like, you know what? We'll save for next year's Christmas. And we're going to save $650. Okay. So if we're saving $650, I have $50 now, and every month going forward, we're going to start with this month. So I'm going to save for 12 more months, and we'll have $650. That's going to be, so being proactive, starting amount $50, I have $50. And then after 1 year, I have it in the savings account, contribution each month, $50. Okay. Particular savings is at 2%. Wonderful. Now you're going to see here, ending balance is $657.55. The total I made on this account was $7.55. You're like, I saved for a year and I only made $7.55. That's fine. That wasn't your goal. Your goal wasn't to create income. And that's what a lot of people will look at. They're like, oh, I don't even bother saving. That's not the piece I want you to look at, okay? Because we weren't saving this money to make a return. We weren't saving this money to make money. We were saving this money for a purpose, for a TV. So even if we made zero interest and we had $650 at the end of the year, that's totally fine, because that wasn't our purpose. Okay. Now, if you said, the heck with savings, I want to impulse buy, even though my TV is doing fine. I know it can last another year. I want a bigger TV now, so I'm going to finance it. I'm going to put it on my card, $650. We're going to stick with the same monthly payment, $50, right? Because that's what we would have did for the year. But the interest rate here is, you see how you get 2%? Well, you pay the credit card company 28%. How delightful for you, okay? So when we calculate that, it's going to take us 1 year and about 4 months to pay off the debt. So we're going to have to pay longer, okay? The TV will no longer be just $650, which it was if we just saved for a year and bought it. Because we had to pay so much more, the total amount you're actually going to be paying for this TV is $783.53. You're going to be paying the credit card company $133.53 to let you buy that TV impulsively right now, instead of just waiting, having the fine TV and just letting it, saving up for the new TV and then rewarding yourself with a new TV. So you thought this total interest of you gaining $7.55 is bad? and not worth it, but then you put it on the card and you end up paying an additional $133.53 for this item. And you might be like, it's worth it to me. If it's worth it to you, I'd say that's not very good finance, but okay. But what happens is this usually isn't a one-time scenario. This is usually something that happens over and over and over again. This year it might be a TV, and then 7 months down the road it might be a new laptop. Then 7 months down the road it might be something else. Because you get into this behavior of putting things on credit, it starts to add up, and that's where people get stuck. So again, when you're using a credit card, if you're going to be using a credit card to help yourself build credit, make sure you're doing it the right way. Necessities. And do not go over that 3%, that 30% rule, okay? If it's something that's not a necessity, a TV is not a necessity, save for it, okay? Because I much rather have you save that $133.53 on your purchase and have more money, okay? So that is my little spiel. If you have any questions, go ahead to type them in. You will see that little control panel. If you wrote down any questions during this presentation, then you can go ahead and type them in now. What's going to happen is we will go ahead and get a email. We will send a follow-up email about 24 hours after the webinar has concluded, and we'll send all those questions with answers to all the participants here today, everyone who registered, and in that way, because I know that people have not wanted to interrupt us. They've had questions, but they came and saw us in person, like, yeah, I had a question about this, but I didn't want to interrupt because you were in it. And I definitely appreciate it, and I think you guys are wonderful, and you're so caring and thoughtful. But I want to get your questions answered because this is for you, okay? And we want to make sure everyone gets what they need out of these classes. So please go to the control panel. There's a little arrow, orangey red, and expand, and you'll see a little tab that says questions. Type them in for us. And once you get those typed in, and you hit submit, that will come to us only, and it will come to us in email format. And so we'll make sure to have this. Also, once this webinar is done, you will get a, once it's done recording and all that good stuff, it will actually come to you in an email, a follow-up email with the actual presentation with the recording of the presentation, okay? And so you guys will have access to that. All right, wonderful. So thank you again so much for joining us. I appreciate it immensely. I hope you got a lot out of this, and if you have any questions, we'll tackle those. Okay? All right. Well, thank you so very much, and I hope you guys have yourself a wonderful day. Bye-bye.